So around the end of the year, I was reading the new tax bill that was proposed by the federal government and actually passed by the federal government. And I saw inside the bill that there was an inequity with regard to state and local taxes, particularly as it related to small and mid-sized businesses. And I just felt like that business owners were being severely hampered by the inability to deduct what would normally be an ordinary and necessary business expense. Every business gets to deduct their business expenses, but because of this federal legislation, a real expense called state taxes was no longer going to be deductible to these businesses. And I became a little bit incensed by it and tried to think about ways that we could work around that. And that's what led ultimately to the notion of the proposal that I sent to the governor and some of the other leaders within the state. I recognized that under the new tax act, that if a business entity itself actually pays the tax, it is deductible. And so what I suggested in the letter was that New Jersey modernize its tax structure for flow-through entities such that the taxes themselves would be paid by the entity, not by the individual shareholders or members or partners of the entity itself. As a result, converting it to deductible expense. The end result at the end of the day would be that New Jersey would be tax neutral. It would receive the same amount of tax, state taxes. The taxpayers, the flow-through entities, would pay the same amount of state taxes, but would receive a federal tax deduction for the payments that are being made, therefore resulting in a savings on their federal tax, my calculations, somewhere between 3 and 4% of their overall federal tax liability. At the end of the day, how they structure the deal or how they write the deal could have unintended consequences. So as simple as it is, the more you peel back the onion, you may get unintended consequences. So things like people that are from out of the state needing to receive a credit for taxes they pay to New Jersey. If an individual is no longer paying the tax, how do they get the credit in that state? New Jersey also has a tax regime where you have to aggregate together your income and your losses through flow-through entities. If it's now taxed at the entity level and one entity has income, you'll pay tax at that entity. How do you ensure that you get the benefit of the loss from another entity? My view and what I said in the letter to the governor was we can write anything into legislation. So we just have to anticipate these complications and just write it into the bill so that it is, at the end of the day, revenue neutral. And so, yes, I came up with an idea, or perhaps others had the idea, I wrote the letter, but really the work of the state society and all the legwork that was done before that to position themselves as a leader in business issues and particularly tax issues was incredibly helpful to get the attention of the legislators as well as other leaders within the state. Let's hope that they do the right thing, they do pass this. It wouldn't hurt New Jersey, it would only help us become more competitive at the end of the day.